Thank you for joining us today. We are talking about when a deal hits stress, how Oak protects investor capital. We are joined by Matt Webster, our Chief Credit Officer, Ryan Anderson, our VP of Asset Management, and Tom Gorski, our Senior CRE Underwriter. A couple of things before we get started. There is a chat column on the right-hand side of your screen. Please feel free to chat any questions. They are private. We can see those, but the other attendees will not be able to. So you can keep that anonymous if you'd like. And at the end of the webinar, we'll have a Q&A session and we'll answer your questions. If we cannot get to your questions, we will follow up with you afterwards. As a reminder, if you have to jump or you can't make other webinars, you will get a copy of this recording within 24 hours. That being said, we have future webinars taking place throughout the next few months. We'll post a link in that chat column. Please visit that and register for any and all of our future webinars. You will get email notifications, and again, you will get a copy of the recording. Also, after this webinar, you might hear from someone named Kevin Kennedy or Brooks Gardina. Both of those guys are here to help and give you helpful information, answer any questions. Again, if we can't get to a question, they'll be able to answer it for you. The QR codes underneath their photos go to their Calendly, which is where you can self-schedule a 30-minute call if you want to talk about anything and everything regarding investment opportunity, etc. This slide will pop up at the end of the webinar if you don't get a chance to scan the QR codes. I want to introduce our speakers today who have taken the time to go through this deal with us. Matt Webster, again, is our Chief Credit Officer. He oversees credit and risk management for Oak and Red Oak Capital Holdings. He brings in over 30 years of experience in global capital markets and real estate finance. He structured over $250 billion in transactions spanning senior debt, equity, and structured lending, and advised on the financing and sale of non-performing loans across multiple countries, global regulatory and capital treatment. Before joining Oak, Matt was global head of real estate finance at HSBC, where he oversaw more than $100 billion in commercial real estate exposure. He also held senior roles at Morgan Stanley and Fitch Ratings, working with sovereign wealth funds, global REITs, governments, and the world's largest institutional investors. Next up, joining us is Ryan Anderson, who is our VP of Asset Management. Ryan oversees a $250 million plus portfolio of commercial real estate loans and equity positions spanning office, multifamily, hotel, and other property types. He leads the firm's asset management and special servicing functions, managing distressed loan workouts, REO dispositions, borrower negotiations, and restructuring strategies. Ryan brings more than 20 years of commercial real estate finance experience, including nearly a decade in special assets and underwriting, where he managed high-risk CRE and SBA portfolios through multiple market cycles. We also have Tom Gorski, who is our Senior CRE Underwriter. Tom owns the underwriting process end-to-end from initial borrower review all the way through closing, analyzing the real estate market, the borrower, and the capital structure on every deal. Before joining Oak, Tom served as Director of Investments at Thrive Senior Living, leading underwriting and asset management across development and acquisition opportunities. He also brings experience from his time in investment banking with Jefferies and CBRE's institutional investment sales team. So he carries both a lender's discipline and an operator's instinct. Together, all three of them will show you not just what this deal looked like, but how they thought about it and the structure and strategy behind it. So with that, I will turn it over to Matt.
Thanks, Nicole. Well, I guess as it says here, why are we sharing this? I think that when we take a look at what we're going to be going over for the next few months in these types of webinars, we're going to be going through a number of different transactions that show what goes right, what goes wrong, and how do we deal with those issues. And the reality is when you sit down and take a look at a new loan, you structure it and you're doing all your underwriting and evaluation, you don't think it's going to go bad. You're structuring everything thinking, I'm covering off all the issues, I'm covering off all the risks. And despite that, things do happen. You're working with people, you're working with properties, you're working with things that can go wrong quite easily. we try to make sure that when we're doing that initial underwriting, we're covering as many of those issues that we can think of so that we don't have major issues come up on the properties. And every time we do have an issue come up, we have that feedback loop in place so that it comes back to our underwriting so that hopefully we don't make those mistakes again in the future. When I take a look at how we approach the lending, there's a number of different kind of viewpoints in terms of what people think means a good lender is and what a bad lender is. When I take a look at the definition of a good lender, I've talked to a lot of people and they say that a good lender is someone who gets the money out the door quickly, they're generating a lot of volume, et cetera. My view is a good lender is a lender that not only gets the money out the door, but they get it back. And so we take that kind of approach when we're approaching both the origination and the servicing, because the servicing is just as important in terms of being able to administer that as the underwriting is. So when we take a look at this transaction, the Hawthorne Manor, what I think would be the best way to approach this is to turn it over to Tom and have Tom explain. You worked on the transaction, you put it together.
Mm-hmm.
What is it that you liked about the transaction, and why did you think it was worthwhile for us to go into this?
Yeah, so this deal was a refinance of a smaller multifamily community in the southern suburbs of Atlanta. And whereas most of the deals that we work on and look at here at Oak, they have some moderate to heavy renovation component to them. This deal had already just completed a pretty extensive gut renovation of all the units and had done a lot of repair and maintenance work to the exterior of the property. So all the heavy lift was done. The borrower had spent about $90,000 a unit in completing that work. And basically was simply looking to refi this deal because it was a maturing loan and he needed some extra time to pursue lease up and get the property to stabilization. So when we started looking at this deal, that's one thing we liked about it, that there wasn't that heavy lift. But it also made us focus in on three kind of key things, 3 points of potential risk. Namely, one, verifying that the quality, craftsmanship, and completeness of the recent renovations was up to snuff and would be competitive in the market. Two, we had to get comfortable with the submarket itself. Like with every deal that we look at, we want to make sure that the occupancy trends are heading in the right direction, that rent growth is positive and gaining momentum, and that there's not an abundance of supply coming out of the market in the near future that could disrupt or work against us in leasing. And thirdly, last thing that we honed in on was really getting comfortable with the borrower's ability to manage and execute that lease-up process. So on the first point regarding market competitiveness, we were able to assess that and check that box through a combination of things. We always get third-party reports, appraisals, property condition reports, phase ones on every deal that we do. But we also do site visits where we'll go and we'll tour the submarket to get a better on-the-ground feeling for that market. And of course, we'll tour the property itself. So we did that. We got comfortable with the positioning of the property. Then we had to get comfortable with the submarket itself, again, in terms of occupancy and rent growth. And we were able to see here that this submarket in the south suburban portion of Atlanta, it consistently demonstrated occupancy above, lost the light here, consistently demonstrated occupancy above 90% and had some consistent rent growth in the range of 5 to 6% on average over the last 5 years. So we were able to check that box. There also wasn't an abundance of new supply coming on. I think at the time we looked at the deal, there were only 50 units scheduled to be delivered over the next 12 months in that market. And then finally, we had to get comfortable with the borrower again and their ability to execute. And on this point, this is where we probably had the biggest point of learning for Oak. But what we did do in underwriting is really dig into the borrower's experience in the submarket and how their current portfolio had performed. And even though we were able to check those boxes and see that his communities were doing well as other multifamily communities, again, this is, as Ryan will walk through here shortly, probably one of the areas where, we, looking back, would have taken a bit of a different approach. And with that, I'll hand it off to you, Ryan, to explain how it went.
Sure, thanks, Tom. So, as Tom just outlined, with this deal, we had sound underwriting. We've got an asset that we like that was recently renovated, and an asset class that we like, and in a market that we like. So what could go wrong? With this one, in short, it was really came down to borrower execution of this business plan. So the loan originated in, as you can see, October 2024. As we mentioned, it was recently renovated property, as expected, as we knew going in, low occupancy at 10%. So the business plan was for the borrower to aggressively lease up the property, get it marketed, stabilize the property, get it in a position where it's able to sustain itself with the monthly debt service requirement. The borrower failed to execute the business plan for a couple of reasons. So come to find out, this particular borrower had multiple irons in the fire, as a lot of developers do, but he in particular had a startup project that was overseas that really took his time and attention away from this project. That was a major contributing factor. In addition to that, again, speaking to the market, come to find out later on, in speaking with the project manager, doing some kind of our due diligence, during the servicing timeline, the 1 units for this particular property were priced appropriately and leased up very quickly. The issue came in with the 2-bedroom units at this property. They were overpriced, and according to the property manager, he had been urging the borrower to reduce the listing price, and due to lack of focus and attention, it was difficult to get a hold of, failed to do so. And that's where a big portion of this business plan failed. So, this time frame of November 24 through May of 25, this was the critical timeline when our borrowers should have been highly focused, executing, the lease up strategy, and again, getting the property to a point where it's able to sustain itself, and be able to, make the interest payments on time through the net operating income of the property. But, unfortunately, as a result of the lack of occupancy, our debt service reserve, which we set aside in case there's a need for the property's inability to make the interest payments, we ended up having to use that 6 consecutive months in a row. So the interest reserve ended up getting completely depleted. And, not surprisingly, by June, we had our first missed payment. So that's kind of a high, brief overview of how and why the loan became trouble. Next, we'll kind of talk about how we manage the process. So, this slide really shows kind of the milestones of what happened post-default. But really, our servicing playbook and our protocols start way before that. It starts as soon as the loan closes. So once it enters into servicing, one of the key protocols and areas of service is clear and consistent communication with our borrowers. So it's not like we got to June, missed payment, and all of a sudden we're taken by surprise and on our heels. Because of our consistent communication with the borrower, our collection of financial statements on a monthly basis, we are well aware of the low occupancy and already urging the borrower to make changes and to get himself to a point where his business plan is back on track. So it's no surprise when we got to June, he misses a payment. We can start with our default protocols right away and jump into that. So we get to here July. The borrower is still past due for June. He misses his July payment. Again, consistent communication. By the time we get to August, he's now 90 days past due. So our protocol at that point, we engage our attorneys. I mean, we had engaged them before, let them know this is coming down the pipe, probably. We send out a notice of default letter, and that kind of gets the clock ticking with the borrower. And again, throughout this process, we're communicating with the borrower every step of the way. What's going to happen, what his timelines are, what he needs to do to rectify the situation. Unfortunately, he's unable to do that. So as you can see, we get to August. And at this point, the notice of default has gone out. With a cure date that's typically 2 weeks to 30 days past due, he's unable to cure. And so we take our next step, which is advertising through a foreclosure advertisement to try to get to the sheriff's sale. So again, that puts a timeline, a defined timeline with the borrower. He understands the next step. At this point, he's acknowledged he's in default. He understands he's got a hard deadline to either cure his defaults or rectify the situation. So what he decided in August, he acknowledged that he was in default, listed the property for sale at $2.8 million, with our support. Once we got to the point where we were advertising the sale, we had a sale date. He wasn't getting any traction at that 2.8 listing price. Again, we were supportive of him dropping the listing price down to $2.55 million. That got him some traction early November. He presented an offer that was going to be insufficient at $2.43 million. We rejected that offer and required him to counter back at the full listing price of $2.55, which was ultimately accepted. So now once our borrower is under contract, we were able to comfortably postpone that sheriff's sale. So just put it off. We can reschedule a later date and let this purchase transaction play out. Ultimately, it did transact, and we were paid off in early February.
So I guess now when you take a look at what the result of that was, ultimately, we did end up taking a slight discount in terms of what the balance was that they were obligated to pay under the terms and conditions of the loan at that point in time. But collectively, through our asset management committee, we took the view that it was advantageous for us to do that. Why? Well, first off, we were getting 100% of our capital return. Second off, we were getting a return which was still very healthy at 15.25. And that is compared to our expected target when we underwrote the loan originally of 15.68. And so that's after allowing for all of the costs for the enforcement, the legals, the escalated fees and so forth. It came out to a pretty healthy return. And if you compare that to where our kind of minimum target is in terms of what we would be expecting for a loan like this of circa 12%, it's still giving us a pretty healthy return relative to that. So from that perspective, everything went well. We got it sold off. We delivered a positive return back to the investors, and it was a good situation. So then the next question is, well, what does this tell you about how we manage the deals and how we manage the capital? And when you take a look at how that underwriting takes place, Tom, first thing starts with the reserves.
Yeah, absolutely. And I think it was a good learning point for us here, and something that we've altered and changed going forward, and that we have started taking a very, very nuanced, close look at monthly cash flows and monthly cash flow projections from the borrower to ensure that all the reserves that we've built into the loan are sufficient to cover potential shortfalls and debt service coverage shortfalls in particular, until the property can sustain itself at a 1.0 debt service coverage ratio. That's some borrowers, need help putting together those projections and thinking through that logic. And, like we mentioned on our last webinar, we're here as a resource to help guide them through that process and help, we won't come up with the projections, but we can, help inform them and inform the way that they think about it. But in all cases, for the loans that we do now and have done since, we've been much more, like I said, nuanced in the way that we structure and think about those reserves, both from a working capital perspective and from a debt service coverage perspective.
And I guess, Ryan, ultimately, when it comes down to servicing, it fell on your shoulders. So, how that process went through.
Yeah, so as a state protocol creates urgency. And like I said, it's clear, consistent communication with the borrower, letting them know what the next steps are, and stating those, giving them a heads up, letting them know what's coming, and then sticking to it, and following your protocol and the next steps, and doing what you're saying you're going to do. And it creates those expectations. It gives them a clear idea of what's going to happen if they don't take the action that you're proposing, and then staying firm with those communications. So creating the timelines, putting those dates out there, that alone puts the pressure on the borrower. It's not necessarily needs to be a contentious situation. It is what it is, and you deliver those messages and stick to those timelines. And the borrower, if you do that early on, the borrower quickly gets the message.
Mm-hmm.
And I think lastly, when you take a look at why we held so firm on valuation, the asset management committee, we took a look at what we thought the intrinsic value was with the real estate. And even though we had an offer of 2.43, we held firm and forced the borrower to try to negotiate the position up to a 2.55, which ultimately they were able to do. And I think it ended up as a positive result for everyone. So now I guess the way to wrap this up is, when you take a look at what that feedback loop provided to us, we've got feedback in terms of the origination, and we've got feedback in terms of the servicing. So Tom, from your perspective, how did that feedback change what we're doing?
Yeah, so like I mentioned, in our diligence process, one of our main concerns was that third bullet of ensuring that the sponsor could execute on the leasing plan. And, the way that I think people, underwriters generally have done that in the past is by focusing on the portfolio and the portfolio metrics that are provided from a schedule of real estate owned, to see how those properties are performing, and maybe look at a couple of the case studies for similar business plans that they've executed in the past. And that's certainly helpful, and we continue to do that, and we will always do that. But an additional piece that we've kind of augmented in our process is taking into consideration not only the historical performance. It's kind of like the stock market. Oh, we got lights back on. Look at that. But also kind of coming up with a pro forma story or pro forma view of how the borrower is likely to perform given everything else that's going on, be it in their life, professionally, personally. We don't hesitate to have those conversations. And, in this case, the borrower, was pursuing a new business in a foreign country and was out of the country, and, neglected to make this property and make this business execution a priority. And, the property suffered for that. So that was a key takeaway, I think, for us, and definitely for me, in really forming the full picture about the borrower, a much more comprehensive pro forma view on how they're likely to execute, not just given the data points of their historical portfolio.
And similarly for you, Ryan, from the servicing, what's the takeaway that you have?
Yeah, I also think this, this experience kind of reinforced our our methodology works, and also just the importance of that communication with not only our direct borrower and sponsor, but really his team, having insight to the team he's built, whether it's a property manager, whether it's a leasing agent, everyone involved, so that we have clear insight into to every aspect that we need to ensure that not only that the borrower and sponsor are focused, but just that we can provide any help that we need to along the way in servicing to help them execute their plan.
So I guess in summary, what I would probably emphasize to everyone is that, when you take a look at how we're approaching both the underwriting and the servicing, we're not just focused on getting the money out the door. We're focused on getting the money back. We've got pretty consistent, aggressive expectations in terms of how we go through and manage that process, because when you take a look at the types of borrowers that we largely work with, you've got to move quickly, you've got to be disciplined, you've got to be consistent, and you've got to make sure that proper feedback loop is going into both the origination side and the servicing side, so that we can make sure that we're getting the loans back in and being a good lender in that respect.
Mhm.
And so that will conclude the prepared remarks. So we'll open it up for question and discussion.
Great. Thank you guys so much. That was wonderful. We don't have any questions right now, but I want to remind the attendees that you will receive a copy of this. Should you rewatch or questions sort of marinate in your mind, please reach out to us. I will list the email address in the chat here in just a moment. And you can always reach out with any follow-up questions. And again, you can register for future webinars at oakrepartners.com/webinars. Thank you for our hosts and moderators, Matt, Ryan, and Tom. Thank you so much for taking the time. And we will talk to everyone soon. Thank you.
Thank you.
Thank you.